Hello everyone and welcome to this NZX virtual investor event. Great to be back after 1 month off. My name's James Sharp. I work on the capital markets team at NZX and we'll be introducing our speakers to you very shortly. Just a quick reminder that this is a Q&A interactive session, so you'll hear 3 presentations, each about 15 minutes long. We'll have 5 minutes for Q&A after each of those presentations. To ask a question, please do so via the webinar panel. It's a free text field, so you can ask anonymously, and we'll cycle through as many of those questions as we can in the time we have. Anything we don't get to, we'll come back to you after the session. Great stuff. So I'm going to now hand over to Amy Castleton, who's Senior Analyst and Economist at NZX, who's going to provide a bit of an economic update for us first, and I'll be back in a few minutes with a few questions. Thanks very much.
Thanks, James, and thanks for the intro. So as James said, I'm Amy Castleton. I'm a Senior Analyst with the Capital Markets Development team here at NZX, and kind of the go-to person for economics insight. So I thought a good place to start would be, where have we actually come from? So we've had a pandemic for a good couple of years now. Most governments around the world started quantitative easing at some point early on in the pandemic. Here in New Zealand, since March 2020, RBNZ dropped the official cash rate pretty quickly when the pandemic started. So they dropped it by 75 basis points at the time, and then proceeded to hold it at 0.25% until October 2021. They also introduced a large-scale asset program, and what that means is that they bought bonds or assets in order to inject cash into the economy. So they ended up buying $53 billion worth of bonds by the time the program ended in July last year. We also had a wage subsidy scheme introduced, so that was intended to help support businesses and keep them running and support the labour market at the same time. While the pandemic progressed, we saw some drops in GDP as New Zealand had lockdowns. So naturally, as everybody was at home and not doing a lot, activity stalled, and we saw some big drops in GDP a few times. The biggest one, of course, was in Q2 of 2020 when we had that large-scale level 4 lockdown across the country. That drop was the largest since 1987, so we don't often experience big drops in GDP like that. Despite that, though, New Zealand has coped pretty well throughout the pandemic. We've had reasonable growth for most of the time, and we've got pretty low unemployment as well. We're now coming into the flip side of that economic cycle. So instead of doing quantitative easing, we're now into the quantitative tightening part of the cycle. And we've also had a few black swan events thrown in for good measure lately. So I'll talk about those a bit later on. But top of everyone's mind at the moment is inflation. So we're at the highest level in more than 30 years. So at the top of this peak here, the last print for annual CPI inflation was 6.9%. Main drivers in New Zealand have been housing and household utilities, food, transport. So every economy is going to experience inflation a little bit differently, but we're certainly not the only country experiencing high inflation at the moment. And we've also got a mixture of tradables, which is international factors, and non-tradables, so domestic factors. So for a while we were hearing a rhetoric of, oh, inflation's transitory, it's being driven by international factors. It's all the stuff around supply chains not working properly, rising oil costs, all of those sorts of things that we can't control in New Zealand specifically. But that's not really been the case. So as we've seen in more recent data, housing's a pretty big factor. That's a domestic factor. Food, for the most part, is a domestic factor as well. So what that's meaning is that the Reserve Bank has a lot of pressure on it to get that in check. And what that means is raising the OCR. So we're now in a cycle where we're starting to raise the official cash rate again, which we haven't been for quite a while. So even pre-pandemic, we were flat for quite a while, and we'd been easing before that. So it has been actually a good few years since we were in a cycle where we actually needed to raise the official cash rate. So we've seen 3 25 basis point rises. So the OCR's generally raise in 25 or 50% rises, usually 25, because they don't want to put too much pressure on at once. And we saw a 50 basis point rise last time the Reserve Bank made their announcement, so that was last month. And we're now sitting at an OCR of 1.5%, which is at 2019 levels, so pre-pandemic. So for any non-economists in the audience, that might seem a little bit counterintuitive. Why would you raise rates and make things more expensive when inflation's already making things more expensive? So it comes back to the adage of high prices cure high prices. So essentially the Reserve Bank's trying to get us to stop spending money. They want us to save it, put it in a bank account, in an investment, in a term deposit, something like that, instead of spending it to try and stop the economy overheating. They're trying to slow down demand. So usually what a lift in the OCR would mean is a fall in unemployment, drop in growth and a rise in unemployment. So we're not there yet. We haven't seen either of those factors come through. Unemployment was flat for Q1, so we've just seen that data out. It's been at 3.2% for the last 2 quarters. So we've been at what's called full capacity for the last few quarters, which basically means all of the labour in the New Zealand market is being utilised. If you look into the detail of that, we do have a little bit of labour that's being underutilised, which means people aren't working as many hours as they would like to, basically. But we're pretty full up on labour. There's not a lot of free labour going around, and businesses are noticing that when they're trying to hire people. It's really hard to find people at the moment. We're due for some new GDP data in about a month, but Q4 was up 3% on a quarterly basis and up 5.6% on an annual basis. What we're expecting to see on that one is when the next lot of data comes out is a small rise, so something under about 1% rather than a fall. So we're not in a situation where we're going to actually see a decline in growth just yet. Another thing worth noting on that stuff is in the Q1 employment data, we did see fewer hours worked. So with the outbreak of Omicron, there's been more people that are working fewer hours or taking time off sick. And that might also indicate a slightly lower GDP figure when we do get that information. So confidence is not great from both a consumer perspective and a business perspective. Consumers have been especially negative over the last little while. The March figure in ANZ's survey was the lowest that it's ever been in the time that they've been running their survey. So consumers are feeling pretty affected by Omicron, obviously. Rising living costs, a cooling housing market, so people might not get quite as much for their house as they thought they would if they're trying to sell now, and a rise in interest rates, so that's driven by that OCR rise that I was talking about earlier. One of the key indicators in that particular survey is people who believe it's a good time to buy a major household item. That was -23 in the last survey, so pretty negative. And it's more negative than we were seeing during the troughs of the 2008-2009 global financial crisis. So consumers really don't think it's a good time to be buying any major items for their household, which is not a good sign for retailers. It means they'll be doing less business. Business confidence has also been tracking pretty low, so it's been steady at -42. So the stuff is on an index. But it was steady at -42 for the last 2 months. Businesses were a little bit more confident on their activity outlook in April, so meaning that they foresee a bit more people coming into their business and buying something, which is not reflected in the consumer survey, but probably a good thing that businesses are feeling a little bit more confident there. Inflation expectations are still pretty high, but pricing intentions have eased a little bit, so businesses aren't expecting to rise their prices as much as they were expecting previously, which is a positive early sign for inflation. We've also seen things be reasonably volatile in confidence on the VIX index as well, so that's spiked up a bit over the last week or so. You can see just in that bottom right hand corner there. So that's the sort of international fear index, and keeps a track of how investors are feeling. It shows that they're feeling pretty nervous and not very, they're pretty risk adverse at the moment. So you're not going to see a lot of people investing in things like tech or stuff that's a little bit more risky. They want to be safe with their money at the moment. So that volatility is driven by a lot of things at the moment. So those black swan events that I mentioned early on, the obvious one is the Russian invasion of Ukraine. So aside from the really tragic human effect that we're seeing on people over there, it's also affected markets quite significantly. So prices for all sorts of things, oil and energy have been the key ones. But also commodities such as wheat and fertilizer. The Black Sea is a key region for a lot of commodities. They supply a lot of the world's food or inputs for making food. So we've seen lots of prices go sky high as things have happened during that invasion. We've also seen new lockdowns in China as they continue to pursue zero COVID. So Shanghai is shut down at the moment. They're opening back up a little bit in stages, but they're still locked down. The port not operating is going to put more pressure on supply chains. We're already getting reports of it being hard to get hold of containers. The port's very blocked up, so freight not coming through is going to affect supply chains a lot more for a longer time again. They're also a key industrial and manufacturing centre, so things not getting made is going to affect production elsewhere and again affect inflation on a global scale. And then we've also got the demand effect on that one. So China's a pretty big buyer for a lot of things, and if people are not earning money, unlikely that they're going to be demanding things from the West particularly, because they're often luxury items. And then we've also got Sri Lanka. So there hasn't been a lot of news space given to that I've seen, but they're experiencing an economic crisis as well. Their inflation is ridiculously high. It was up 30% in April. It has stabilised a little bit recently. They're undergoing negotiations with the IMF to try and dig themselves out of the hole. But people there are struggling to survive. They can't afford things. So that's kind of where we're at economically at the moment. So what does that mean? Volatility is practically a given at the moment. All of those black swan things that I just talked about aren't going to go away anytime soon. So we'll continue to see some volatility driven by those in particular. And the pandemic. The pandemic's not going away anytime soon either. So that's probably going to continue to drive a bit more volatility. Inflation's still pretty high. It's likely in New Zealand that we'll see it start coming down soon. We are seeing some good signs of some things slowing, like housing prices. But the Reserve Bank's going to need to continue to rise the official cash rate for a little while yet. We will likely see a little bit slower growth for that reason. But it won't necessarily be negative. We may not see a recession, but we will see slower growth. Unemployment, we're starting to see Kiwis leaving the country. We've got all of those young people that didn't get to go on their OEs that now want to do that, now that they've got a chance, that might go and take a job overseas. So we're likely to see the employment market tighten up a little bit further as we see those people leaving. But we are starting to welcome international visitors back as well, so that might ease up some of the pressure. That will probably be a bit of a cycle there, and definitely something to keep an eye on. But that's kind of where things are at, and that's me. We produce a monthly economic report. It's free to subscribe. Take a look at those links there if you want to subscribe, or look at some of the previous reports, all done by me. So happy to take any questions if there's anything.
Thanks very much, Amy. That's great insight there. Great to hear things broken down in what is a very complex world, I think. So we do have a couple of questions. The first of those is, what happens when there is stagflation, and how will monetary and fiscal policy react to stagflation?
Good question. We haven't seen stagflation in New Zealand for quite a while. it's a difficult one to deal with, and it depends on what the Reserve Bank thinks is more important to deal with. So at the moment, that's inflation. If growth starts getting worse than what they perceive inflation to be, I expect they'll start dropping the OCR again. But it's definitely a balancing act to try and avoid that situation.
Okay, thanks, Amy. One more is, and this is more of your economic prediction type question. What will trigger consumers to regain confidence? How long do you think this will take? Which is probably the $1 million question.
Well, in my view, that the consumer sentiment issue is twofold. So on one hand, we've got inflation, prices getting really high, price of basic necessities, groceries getting really high. So I expect if we see inflation start to fall a wee bit, that will improve that sentiment on that part of it. But we've also got the pandemic as well. So if people are not wanting to go out and spend money because of the perceived risk from the pandemic, that they're worried about catching COVID and what that might do to their lives, having to isolate or whatever it might mean for their personal situation, then that affects sentiment as well. And that's a bit more out of control. So until we probably see a bit more, a bit of easing in the pandemic, so fewer case numbers and things like that, then that might drive a bit of that negative sentiment for a while yet.
Okay, thanks very much, Amy. That's great stuff. Thanks again, and speak to you soon. That was Amy Castleton, economist at NZX. Fantastic, thanks, Amy. So now we're going to move on to our first of our issuer presentations. And to that extent, it's a warm welcome to Andrew Jeffries, who's Chief Executive of New Zealand Oil and Gas. Wellington headquartered New Zealand Oil and Gas was founded in 1981 and is one of the longest listed issuers on NZX. Has production interests offshore South Taranaki, onshore in Australia's Northern Territory and Indonesia. Over to you, Andrew. I'll be back very shortly with some questions.
No problems. Thanks, James. And Amy, really hard act to follow. I'm hoping that I've got some better news than you had. It's a bit scary out there in the world. Tēnā koutou, tēnā koutou, tēnā koutou katoa, and g'day. I'm Andrew Jeffries. As James said, I'm the Chief Executive of New Zealand Oil and Gas. We're the largest and smallest listed exploration and production company listed on the NZX. We also have a foreign exec listing on the ASX. Though it's not well understood on the NZX, our business is actually to understand the Earth, and we use cutting-edge science and engineering, and that market is people, and those people run industries, they run power plants, they heat homes, they heat showers, and they cook their sausages and salmon. So it's a key part of the economy, and we're a key industry. You see on this title slide is in fact an amazing sunset over the Mereenie production station, which I'll talk in Central Australia, which I'll talk to in a little bit. So before we crack on, I will, hang on, there we are. Just our disclaimer, it's an excellent read, and look, I'll leave you to have a look at that at your leisure after the presentation. So in this webinar, what I'm going to try to do is give you a snapshot of the company, where we operate, who's at the wheel, what we've achieved, and finally, what we're busy with, and with some details of a recently announced equity raising. So as James said, we're active in Australia. Last year, we bought into the Amadeus Basin fields in Central Australia. That picture of Mereenie was part of one of those 3 production stations. These fields pump gas into the Northern Territory market, and the Territory is where we're going to require and acquire all of our e-materials, all of us, over the coming decades as we move forward through the transition. It's also got pipeline access across onto the east coast of Australia, which has really vibrant domestic and LNG export markets. So great place to have gas production. We're active in Indonesia through our Q subsidiary. They supply gas from the Sampang gas fields in Java, direct into a dedicated power plant, and further north in Sumatra, they're producing light oil at the Mahato field. In New Zealand, we participate in the Kupe field, which is offshore Taranaki, and that is a key contributor to New Zealand's energy mix. We also, through Q, have a share in the Maari oil field, which is about 80 kilometres off Wanganui, and our office is based in Wellington. Just a quick snapshot. Look, we have a clear strategy. We know what we want, and we have a track record of delivery. What we're after is well-priced production with some development upside that we can tie into infrastructure and into markets. And mostly that comes with some exploration as well, which can similarly be explored and tied into those markets. We've got an incredibly capable team here who determine the right price to pay for those things. We don't overpay. We've got a globally connected, well-capitalised, financially savvy cornerstone investor who work really closely with us to ensure that the company creates shareholder value. Growth is still a key focus. We've delivered about 5 times on our reserves, and I'll come to that a little later, by using our brains and our wallet, and we're now taking those acquisitions and looking to expand the reserves further using those brains and the drill bit. That said, we like the areas we work in, particularly Australia, because of those gas markets, and so we're still looking at acquisition as well. So we've got organic as well as potential acquisition growth. Who are we? Let me give you just a brief picture of who's managing your investment in New Zealand oil and gas and what we believe in. So we're a team of 20. This is the leadership team. We've got diversity in skills, gender, nationality. We've got scientists, we've got engineers, we've got finance experts, and we've even got a lawyer. The management team alone has about 150 years of global oil and gas experience. And I know that's hard to believe. We're a terrifically youthful looking bunch. In terms of ESG performance, we don't just think of sustainability as a badge, we actually try to live it. So we were at the forefront of reporting using the Task Force for Climate Change Financial Disclosure Criteria, TCFD. We offset our Scope 1 emissions. We find gas that displaces coal. We support a safe, inclusive workplace, and we're the only oil and gas company in the region to have a rainbow tick. We don't tend to spend a lot of money on supporting external organisations, but where we do it to make an impact. So the Salk Institute, the Salk Institute are engineering everyday plants to sequester CO2, and the Dunedin Curtain Bank takes materials that would end up in a landfill and turns them into fantastic curtains, heavy, warm curtains to keep families' fuel bills down and keep homes warm and families healthy. They are a great organisation, and if you haven't had a look at them, Google them up on the web. Really, really good, high quality organisation. I wanted to talk to you about our values because they're not just something we've got on our front wall, and we do have them on our front wall, but they're actually in everybody's performance plan, and they're about the way we do business. So tikanga is about doing the right things the right way. So we want to ensure that we put the ladder up against the right wall before we try to climb over it. Mahi tahi means that we work hard and we work as a team. Pakiki, as scientists and engineers, we solve problems. And to do that, you have to be open and you have to be curious. And last but not least, tauhoko hoko, which is about barter and trade, because we are really commercially focused. We know that we have to produce the goods economically to earn our shareholders' trusts and further investment. So, which brings us to, what have we done for you lately, shareholders? As an army marches on its stomach, an exploration production company goes forward on our reserves. You'll see in this graph, working from the left-hand side over the last year, we've increased those reserves around about 5 times. We've been executing the Amadeus purchase, we've installed gas compression at Kupe, and Q started drilling out the Mahato field. Looking further on the right-hand side, we have a bunch of contingent resources and prospective resources. So we've still got potentially got gas in those tanks, plenty of gas in those tanks, and that's the next steps towards the organic growth. And we'll talk a little bit more about what we're doing in the activities we're undertaking when I talk about the equity raising. That's where the strategy delivers long term. It's building those reserves. If we look at the financials, those reserves do feed into the bottom line, and that's what we're seeing. So down the bottom half of that slide, you are seeing the cash effect. We are spending cash. Cash balance has been dropping down, but if you look at the top, we've been spending that cash wisely. It's still pushing up our revenues. It's pushing up our operating cash flow. So it is making a real difference. We are active, and it's making a real difference to our returns. Now, if we look at the markets, I'd like to talk a little bit about the future. So I'll talk about activities in a sec. Let me talk to you more generally about the markets. So we are active in some great markets. As Amy was saying, energy prices are rising. And so in New Zealand, gas prices are going up. In the east coast of Australia, there's actually a supply-demand gap that's on its way. And in Indonesia, where we're producing oil, the oil price is rising. I don't have to tell anybody that the oil price is rising. We're all feeling it at the service station. People need the products that we're producing, and we want them to get those products at a reasonable price. We don't want the customers facing a heat or eat decision. You've got to produce these products to meet the demand. Finally, I'd like to talk to you a little bit about our place in the transition. I often get asked, or get told, actually, that renewables are going to substitute gas. I'm not so sure, given the inherent interruptible nature of renewables. I think they're actually complemented by gas, and New Zealand Oil and Gas has 95% of our reserves in gas. In all the markets we produce gas, the marginal electron comes from coal. That's true in New Zealand most of the time, and certainly all the time in Australia and in Indonesia. So the gas we produce supplants coal. Renewables are making some amazing inroads, and there's a lot of smart people involved in that industry, and it's great news. But the sun doesn't always shine, and the wind doesn't always blow, and gas can be there to pick up the load quickly and reliably. So what you see here is a battery energy storage system at the Owen Springs Power Station in Central Australia. Our Dingo gas field feeds that power station. That's all it does. That powers Alice Springs, which has 40% solar and is rapidly heading towards 50% solar. When the sun doesn't shine, that 5 megawatt battery picks up the load and allows time for the gas generators to come on, which then carry the load forward. So it's a great example of gas's part in the transition. So gas is the solution to a workable transition, and that is a transition that's going to take decades. So, I think we're a complement. Lastly, let me talk to you about the equity raising. So we announced on the 27th of April and opened yesterday a $25 million equity raising. I just want to talk you through what we're doing with that raising. So we've got a bunch of opportunities that I've alluded to previously, and we're looking to fund those. So in Australia, right this minute, we have a big rig working for us at the Palm Valley field in the Amadeus Basin. It's drilling a deep exploration probe in an as yet untested zone. But if we don't find gas in that deeper zone, then we'll be bringing that well back up and we'll be putting a sidetrack into an existing producing interval. So that well will not be wasted. That is smart exploration. Both at the Palm Valley and Mereenie fields in the Amadeus, we have more infill opportunities in the existing producing intervals, as well as discovered but untapped, what we call contingent resources. So that's things that we know are there, but we haven't tapped them yet. And they need to be appraised. At Dingo, there's deeper prospectivity, as well as an infill well opportunity. So there's gas to be won in the Amadeus Basin. That's why we bought into it. And coupled with the spare plant capacity that we've got and pipeline capacity and a really keen market, that's a place we want to invest. The other opportunities on our tree there are the at Kupe, we have an opportunity to put an infill well to secure New Zealand's gas production at a time when the market prices are rising, and we've also got the gas contract rolling off. And finally, Q's joint venture in Mahato is continuing to drill up the Mahato field. That's coming along quite nicely. They've also got a discovery at Paus Biru, which needs to be tied back to Sampang. So we're looking to support Q on those activities. Sources and uses. So the sources of funds in the next wee while are going to be our revenues, they're going to be our cash and the equity raising. And then if you cast your eyes over to the right, you can see the uses. So the lion's share is going to the Amadeus Basin that I've been talking about. We've also got the Kupe infill well. We've got support for Q because we want them to keep up in their activities. And we've also got to maintain some working capital. So these are the opportunities that we have. They're really high quality. We want to pay our way and they will add value to the company. So finally, key dates. Look, the announcement, so you can read through those. Essentially, the offer is currently open. And we'll be closing the offer on the 23rd of May at this point. So look, just to wrap up, New Zealand oil and gas is good to grow. We're an exciting, unique company on the NZX. Existing shareholders, have a look at that equity raising. Personally, I'm an existing shareholder. Personally, I'll be taking up my allotment of shares and I'll be looking to get some more. There is an oversubscription facility. Potential shareholders, have a look into our business. We've got some real growth coming down the pipe at us. And I'd really like you to be on the journey with us. So look, thanks, and back to you, James, for any questions.
Fantastic, thanks so much for that, Andrew. Really great presentation, a great insight into the business. We do have a few questions here. So first of all, and this is in reference, I think, to your points around renewable. So maybe this is if you've got anything to expand upon or to reiterate. Massive worldwide push to renewable energy as opposed to mineral extraction in this question. Are New Zealand oil and gas planning to operate in that space? So really, anything you want to expand on or reiterate, I think, what you kind of said already on that subject.
Yeah, look, we do have scientists and engineers, and scientists and engineers can work on different things. But we are an oil and gas exploration and production company. At this point, we we're not looking deeply into the renewable space. I see gas in particular as a complement to renewables. So, you know, I can definitely see a place where you've got, you know, renewable generators who are needing good backup, like we've got at Dingo, and that's probably the place that we'll be working in. But as I say, we do have scientists and engineers. So
great, thanks, Andrew. And then the next question here is, I guess, your view on something. So, does New Zealand need a modern oil refinery to produce its own petroleum products? Any views on that one?
Oh, look, I started out my career as a refiner, so I do love oil refineries. My family find it quite odd, but I find them quite beautiful in the evenings. Look, even as a refiner, it's a difficult question, because the crude that we refine in New Zealand comes from the Middle East. So you are already, in terms of security of supply, you're already bringing in shiploads of crude. The large refineries, and the refinery that I started out my career in Sydney, is now an import terminal because it just wasn't big enough to compete against the super refineries in Asia. So while it's no longer my area of expertise, I would say, look, are you more secure bringing shiploads of product in or shiploads of crude? You know, I think you've got to leave it to the economics to decide.
Okay, fair stuff. And I think we've got a question for one more. There is another one we'll probably do separately. How much untapped oil and gas do you believe is still in the Taranaki Basin that New Zealand could extract in the future?
Look, if you look globally, the Taranaki Basin hasn't had that many wells drilled into it for a basin of its size. So you would argue on a numbers game that there should be additional volumes to discover. And, you know, certainly there was a fairly vibrant industry there. So I would say, yes, it's a basin with petroleum. It's a reasonably large basin, and it hasn't got the density of wells that you would expect. So we call it the creaming curve. There should still be discoveries there to be made of a good size that would would be worth exploiting, particularly into the current market. I think the other piece coming to that, the piece about security of supply. So if we did have our own crude supply, that would change that would certainly perhaps change your mind about refining. But it's also down to any of the oil that we don't find and produce here has to be shipped in. So you got CO2 associated with those, all of those industries that are sending that finished product to us. So, I'm a believer that countries should try and lift their own load in terms of energy supply where they can, and you don't have those travel miles attached to your goods then. Okay,
no, interesting. Okay, the other questions that have just come through, we're going to send through I think after the session, because we're just out of time. So Andrew, really big thank you for presenting this afternoon. See you again soon. Enjoy the rest of your day, and yeah, thanks again. Thanks,
no problem.
Andrew.
Thanks, James.
And thank you. And then last but not least, we're going to turn to Aaron Hockley now, Fund Manager of Vital Healthcare Property Trust. Vital Healthcare Property Trust is the only specialist owner of healthcare property listed on the NZX. Key mission is to deliver stable and growing total unit holder returns, a majority source from healthcare real estate. Over to you, Aaron, and again, I'll be back in a few minutes with some questions. Thanks.
Thanks, James. Good morning, everybody. Atamarie. As mentioned, I head up Vital Healthcare Property Trust, which is the fourth largest listed property group on the NZX and the only specialist healthcare landlord. Vital has been listed here for over 20 years, and its total return reflecting distributions and unit price movement was 15% for the year ended 31 March, which was well above the NZX 50 and the wider property index. Vital is managed by global real estate healthcare fund manager and investor Northwest, which is listed on the Toronto Stock Exchange. Northwest hires me and my colleagues to deliver Vital's unit holders. And that includes Northwest, which is Vital's largest holder at just over 27%. Northwest owns and manages healthcare property across Europe, North America, Brazil, Australia, and New Zealand. So has very deep experience across all of those markets, and we're able to bring that into a New Zealand and Australia context via Vital. To provide additional protection for Vital's unit holders, Vital also has a majority independent board. Today, I'll talk you through our recently announced rights offer, which closes this Thursday, our recently announced acquisitions and developments, and provide some observations on the market. This last part is really my own opinions and are not to be taken as those of Northwest or Vital's board. And obviously nothing discussed here is intended as financial advice, but more to give you some thought starters for your own investments. Further details of our assets, our returns, our governance, etc., are available on our website, vhpt.co.nz. Vital only invests in quality healthcare real estate in Australia and New Zealand, and we divide these into 4 key market segments. Firstly, hospitals. Currently for us, that's only private hospitals and representing nearly 80% of Vital's portfolio. These assets are tightly held, relatively infrequently traded, and dominated by a few major operators. For illustration, in New Zealand, the 3 largest operators, Southern Cross, Mercy Ascot, and Evolution, represent around 60% of private healthcare. And this is why all 3 are key tenants for Vital. Ambulatory care is the second key market segment, and these are essentially walk-in facilities like day surgery, specialist cancer care providers, and allied healthcare providers like physio, and currently represent around 15% of Vital's portfolio. Thirdly, aged care, which is highly fragmented across both Australia and New Zealand, but increasingly dominated by large players like Ryman in New Zealand and Bolton Clark in Australia. Currently, aged care represents around 6% of Vital's portfolio. And finally, the 4th segment, life sciences, bringing together laboratories, university and other research centres, as well as pharmaceutical companies. This is a growth area across the world and something that we're keen to expand in. However, Vital is yet to make an investment in this sector. Healthcare real estate is typified by long leases, and Vital's weighted average lease expiry is just under 18 years. New hospital leases are typically 20 to 30 years, compared with 3 to 10 for office, 5 to 15 years for industrial, or 1 to 5 for retail. So you really see those long-term leases, and this provides long-term income support for our unit holders. Healthcare real estate is underpinned by operators who are less susceptible to the economic or business conditions that Amy was talking about at the start of this call. And this is due to high levels of government support, low discretionary spending as a percentage of revenue. Perhaps on some personal reflections, I've spent the last 14 years in equity markets and longer in property specifically, and we're clearly facing significant challenges that Amy mentioned earlier. COVID, Russia, inflation, just to name 3 of these. I've experienced several major downturns in the early 2000s, and one major downturn being the GFC in 2007 to 2008. So in some ways, my experience is limited, but definitely not just to one market or just a moving up market. And these are probably my key reflections on that time. The first is that the best decisions I've ever made or been part of were in the midst of crises. Pricing is impacted, people panic, and lose sight of the long-term fundamentals. It is the long term that matters the most in every business decision, and this is even more so in real estate and healthcare, even more so again. Secondly, volatility is good for the market. It highlights the weaker players, restores distinction between premium assets like those that Vital owns and lower quality assets, and reminds people about risks. I would go so far as to say that equity markets have a reverse gravity impact. What survives is better and goes higher as a result. And finally, inflation challenges investment markets. Property is disproportionately impacted as property relies more on debt than other sectors, so a rise in interest rates is bad for property in the short term. However, over the medium term, inflation has historically been a huge tailwind for property, as unlike some other asset classes, property is a physical asset that people need. If costs go up, this will eventually lead to higher land prices and higher construction costs. If replacement costs increase, this supports both the value and the underlying asset of the rent that we charge. So now I want to take you through the capital raising we announced a couple of weeks ago, and which, as I said, closes on Thursday. So we're raising $200 million to fund $225 million of new acquisitions and developments, all of which are in New Zealand. The first acquisition is of a new health precinct in Queenstown, and the second acquisition is of a large existing building in Christchurch. Both of these acquisitions are underpinned by key tenants, in Queenstown's case by Southern Cross, and in Christchurch's case, the District Health Board. Both of these acquisitions also come with significant development upside, and for Vital, that's where we expect the bulk of our returns or additional returns beyond rental increase to come in the future. The other uses for these proceeds are to expand and develop existing hospitals in Auckland. The first is Ormiston Hospital in southeast Auckland, and we're approximately doubling the size of this facility. It's leased to a joint venture dominated by Southern Cross, and then Auckland Endoscopy, which is operated as a joint venture between Evolution Healthcare and Healthcare Holdings. These two developments are in addition to our existing development pipeline across Australia and New Zealand of just under $300 million, with about $218 million left to complete. These developments will significantly improve and enhance Vital's existing portfolio and provide accretive returns for our unit holders. These acquisitions are the first in the South Island, and so will lead to Vital having about 4.7% of the portfolio being in the South Island. It will also increase exposure to New Zealand, taking our New Zealand weighting up from 26% to 30%, with the balance being in Australia. And you can see our other key metrics there. As I mentioned, a weighted average lease expiry, or WALE, of just under 18 years, and a total portfolio value of $3.2 billion, so a significant entity. It's important to note that around 85% of Vital leases have annual rent increases aligned to CPI in some way. So this provides some level of protection for unit holders, with growth linked to CPI as we enter a higher inflation environment. Then I want to provide a bit more detail on the individual acquisitions. So the first, as I mentioned, a new precinct. You can see in the bottom right-hand corner, the precinct we're acquiring, comprising 6 buildings. The key or anchor part of this development is the Southern Cross Hospital, but you also have radiology, retail, consulting, medical centre, and childcare. About 40% of the leases by income increased by the greater of market and CPI, again providing a high level of income support for our unit holders. The purchase price of $95 million represents an existing developed asset of about $91 million, plus the land immediately available for development of about $4 million. It's in a key growing catchment in Queenstown, and is on the road between Queenstown and Arrowtown. The second, 68 St Asaph Street in Christchurch. this is the building shown in orange, is really surrounded by existing public health and DHB buildings. It's an existing facility, was previously the police station, and is currently being fitted out for a new maternity facility for the DHB. It comes with significant development land, which you can see is about 300 metres from the hospital, and we'll seek to develop that for a new healthcare facility over coming years. The acquisition price at around $50 million provides an incoming yield of about 5.1%, well above our weighted average cost of capital, and so is highly accretive for our holders. As I mentioned, we have acquired Endoscopy Auckland and are working with the existing operators to double the size of this facility. The new facility will house the existing endoscopy provided from the existing facility, and we will repurpose the existing facility for a mixture of endoscopy and other day surgery needs. The incoming yield is 4.75% on the $22 million purchase price, again accretive for us. And then the development yield on development costs at just under $22 million is a bit over 5%, again highly accretive for our unit holders. And finally, we're expanding Ormiston Hospital, as I said, nearly doubling the size of this facility, cost of approximately $40 million, including land we already own, providing a net yield on development costs of a bit over 5.5%. You can see there on this slide the uses of the $200 million we're currently in the market raising. This includes other acquisitions announced earlier in the year in Australia. Following the raising, we will have a balance sheet gearing of around 33%. So this provides us with a lot of comfort given where interest rates are moving, and any movements in property valuations, bearing in mind that they could be negative, which will be a bit of a change from what we've seen previously. We have essentially a significant buffer to weather any storm that we may see. I do believe that if interest rates go up, that it will be relatively temporary. I don't know how many months or years we're talking, but I do see, for the reasons that Amy's pointed out, that it's likely to be short and sharp, and so we would be expecting inflation to return back to more historic levels, and that should provide more support for our property portfolio overall. And so finally, to wrap up, Vital provides an opportunity to invest in New Zealand and Australian healthcare. Its income is highly aligned with CPI, and so provides a natural hedge against inflation. It's highly defensive due to the income coming from healthcare, which has a high level of government support and a high level of non-discretionary spend. Happy to take questions.
Thanks very much, Aaron. Great presentation, and great insight again into the business, particularly around your kind of thoughts around kind of pivoting our thinking in sort of longer term as we kind of concentrate ourselves in the short term as well. So we do have a couple of questions. They're very similar, so I'm going to ask them together if I may. Question one is, how many more opportunities exist within the New Zealand market for further acquisitions? And the second question is, does Vital Healthcare have a geographic focus when it comes to acquisitions? So perhaps
sure.
The two.
No, thanks, James, and thanks for the questions. So the first, in relation to existing opportunities, the New Zealand market isn't large, both due to the size, but also the opportunities for Vital to invest within the parameters where we're looking for assets above $25 million. There aren't a lot of healthcare assets that are available that we don't own already. So that's part of the reason why we are embarking more on a development strategy. So we will seek to develop new assets for the market, we believe that there's not enough infrastructure for the healthcare needs in New Zealand, particularly in high growth areas. And so we have bought land in advance of this need, and we'll seek to develop that over the next few years. We think that public health in particular will need to be delivered more from private facilities, both by private operators, but also by the public sector leasing more space from the likes of us in existing facilities. So we think that provides good underlying support for developments, and we'll look to execute that over the next few years. Secondly, in relation to geographic split, we are targeting having a minimum of 20% and a maximum of 40% in New Zealand, and the balance being in Australia. So we are relatively agnostic between Australia and New Zealand. You know, there's advantages and disadvantages from both, but just the bulk of the opportunities are in Australia proportionately. So more of the opportunities are likely to come from Australia going forward.
Okay, fantastic. Thanks, Aaron. Two more questions, also about acquisitions, which is probably not surprising. Question here is, what is the minimum yield you look for when assessing acquisitions?
I think minimum yield is a little bit misleading, because you could have a very high yield that is on a property that isn't high quality, and so would be outside our thresholds. Conversely, you could have a very low yield, or what's seen as a relatively low yield, but presents a number of upsides, whether that be through income growth, and I've talked about CPI a couple of times. We have leases that are linked to CPI that can provide a bit of growth. There can be strategic reasons in terms of expanding with a particular tenant, or needing to work with either an existing relationship or a new relationship. Or there could be other opportunities, and the biggest one for us is really the development story. And as I said, all of the acquisitions we've announced this year have really been about development opportunities. So we've announced 2 acquisitions in Sydney, one in Christchurch, one in Auckland, one in Queenstown, and all of those opportunities come with development upside. And that really builds on a strategy that's been in place for some time, to acquire either underutilized facilities, or facilities which we can expand and grow with operators as healthcare needs arise, or as operators need expansion.
Okay, great stuff, thank you. Just going back to my question sheet, is there a desire, the very simple one here, is there a desire to expand beyond healthcare?
Look, potentially. I definitely wouldn't rule it out. At the moment, we have it's called a SIPO, statement of, I forget what SIPO stands for, but it is limited to healthcare. We do have some childcare in the portfolio, really as ancillary assets. I think that that SIPO will remain under review, but I expect that it'll be predominantly around healthcare or healthcare-like assets. You know, obviously the board can change that and would provide unit holders with details, but the expectation is that it's probably healthcare or healthcare similar. You know, there might be a growing opportunity in social infrastructure, and we are reviewing that all the time. But at the moment, there's enough opportunities for us to focus on in healthcare. We've just acquired, you know, with $225 million of new transactions announced this month, the last couple of weeks. So there's a lot to build on at the moment, but you know, we're always looking for the best opportunity for Vital's unit holders.
Okay, great, thank you. And as I turn back here, I think we do have another one. A final question, again around acquisitions. Is it becoming harder to find attractive acquisitions given rising rates and build costs?
Yes, well, it's become harder for a number of reasons. It's become harder because there's increased competition in the marketplace. So we're seeing a lot of institutional buyers, a lot of institutional money in both Australia and New Zealand chasing assets. So that has compressed yields, and that has made it harder for us to acquire, and we've missed out on a lot of transactions because it doesn't make sense for Vital's unit holders as a result. So that's been a key thematic that's been going for some time. I think in some ways, rising rates, as I said, sort of in the opening reflections, actually provides us with more opportunities because it brings a bit of realism to the market. And what we're seeing, for example, is that there's less demand for land from apartment developers in both Australia and New Zealand because the returns are harder to achieve due to rising costs on both the debt side and also costs, construction costs. So that provides opportunities for us. We are particularly focused on, debt costs. It does go into our models, etc. But as I said, we're investing for a very long term. The bulk of our investors are New Zealand retail holders. A lot of them have held for 20 or so years. They really look through those cycles, and so we want to respond similarly. And so we don't want to build a strategy that's based on very short-term movements or potentially short-term movements in interest rates. We really want assets that deliver longer term for unit holders, and a key way we ensure that they do that is linking rental growth to CPI, because as CPI moves up, interest rates probably move up similarly, and so you get that natural hedge.
Yep. Okay, great. Again, thanks very much. That's it. Actually, that's all the questions. We had quite a few around for you today, so great stuff. So I think we're going to conclude there, which is after 1 o'clock. So Aaron, massive thanks for your presentation this afternoon, and no doubt we'll see you very soon. So I'm just looking away because my camera's a different position to your face, so I am looking at you. So thanks very much, Aaron, and thanks indeed to all of our presenters, to all our presenters this afternoon, and also thanks to you all for joining us today. We are going to be back next month with some more issuers on the call, and so in the meantime, wishing you all the very best